Okay. Thank you very much, everyone, for your patience. I greatly appreciate it. So, anyhow, I am here today to talk about advanced tax strategies for high earner veterinarians and their practices. I am from Corcoran Business Advisory Service, which is um, it's a virtual firm that I started. I used to have a brick and mortar firm for 30 years where I practiced compliance, accounting, and taxes, and I loved it. And then I decided I really wanted to be virtual. We sold our practice last year, and I am helping equine, large, small animal across the nation, working on cash flow, profitability, long-term financial outcome, and taxes. And taxes really seems to be a big piece that seems to be missing for many practices. So we're concentrating on that tonight. I am the author of The Vet Advisor. Are you running your business or is it running you? And I'm also one of your crazy clients because I ride FEI and AERC endurance. And hopefully I'll be going into a 100-mile ride at the end of this month. So question, are you paying 50% of your income to taxes? If your income is over 250,000 and you're paying more than $30,000 a year in taxes, you may be paying too much. But even under that level, we have lots of options where we can put pieces in place that really help save taxes. But sometimes when it gets higher and higher, there's even more strategies that are available. So I work with my clients as they reach those levels. Now, if you're also working in either a larger animal hospital or in a practice with like-minded practice owners, or maybe you're on your own, there's a variety of strategies that are available to you. But it takes work and documentation to make sure that implementation takes place because some of the things really require that you have the documentation, that you have the pieces in place, or else the IRS could come in and audit it and then throw it out and you have a problem. So the question is how do you become aware of these tactics that are available, that it's legally approved? And I will talk about that later. So I could talk to you about the code section and about, how do you save taxes? And I could give you a laundry list of things to look for. But I really feel like telling stories is a little bit more powerful. So I'm going to go through 2 case studies. And then I'm going to talk about just some general things to keep in mind when you're looking at your personal tax return or some of the things I look at when I'm addressing someone's personal return, especially when they either are a high earner or they have a business. So the first case study is an example of some strategies that were passed through the business. The taxpayer was 100% single member LLC, small animal vet that started a new practice and grew into a decent sized practice with 20 employees, and they had over $1 million in revenue. And they were still filing on a Schedule C, which gets attached to the Form 1040, which is all on the personal return. And the reason this is important is because when you file a Schedule C, all of that net income is subject to self-employment tax, and that is 15.3%. So we really want to be able to control that and say, let's not necessarily pay all. We do want to pay FICA taxes because we want to be eligible for Social Security, but we want to limit, that we don't have to go to the maximum amount of our income and pay on that. So we want to make sure we watch that. The preparer that worked with the practitioner before had ignored the balance sheet because it was only a Schedule C, missed some fixed asset additions as well as some loans. And because those were open tax years, which means you can go back 3 years, the IRS allows you to go back and amend. We were actually able to go back and amend those open years and free up some tax dollars by doing that. And what was happening is the owner was continually running behind the 8 ball. They owed around $60,000 a year annually. They couldn't get caught up with the IRS. They'd end 1 year finally at break even, and then they'd start paying taxes over and over again. And they weren't able to make estimated tax payments or proactively plan. They were always playing catch up. They also had some associate doctors that had some student loan debt. So this is going to be important for this example. So what we decided to do was we said, you know what, it's better not to be filing the Schedule C. We want to put you into an S corporation. And I know many of the practices that I work with right now already make that step. They go from the LLC and they immediately become an S corporation. And usually that's the best way to go. But anyhow, in this instance, that had not happened. So we filed the entity change with the 8832, and then we ask to be treated as an S corporation on the IRS level. The states usually honor the S election, and we just have to be careful with that because in New York City, they do not honor the S election, and that can be very costly. So we always have to make sure we watch all levels to see that it's going to play out the way we think it is. We set the owner up on payroll, and we have to look at his reasonable salary to pay. We opened a 401k plan, and we made sure that the owner was maximizing their contributions by setting up their payroll accordingly, mapping it out through the year. And the other thing we did, which is not necessarily a tax dollar savings, but more of a cash flow preference, was that we made sure that we withheld the amount of taxes that was needed to pay the taxes at the end of the year by planning. So we were able to build that in instead of doing estimated tax payments. And that's a personal decision. Some people like to receive that net, save the money, pay the estimates 4 quarters, and be done with it. But this person decided it was better just to have it taken care of. We also added an account, well, a education reimbursement plan, and this is available up to $5,250 per person. And you have to make a decision because it then becomes eligible for all 20 employees, and you have to decide how much everybody's going to take advantage of. And it's dependent upon how much the employees take advantage as to, well, how much the employer is able to take advantage. So in this instance, it turned out to be $15,750 of education reimbursement. But what changed this year and is new, because of the tax law that came into play in July of 2025, is that student loan principal and interest payments are available for this educational reimbursement. So it's something really nice, especially for your associate doctors or new doctors coming into the profession. It's a big help to help them pay that money down. So as you can see, we have the overall summary of the effects between the federal and the state, and then it's broken down by strategy. So the shifting to an income, an S corporation saved about 29,000. Maximizing the retirement contribution saved about 10, and the education reimbursement saved a little less than 5. So altogether about $44,000 of savings, and that's between the state and the local. So that's case one. Case two is an example of an existing practice that was that we wanted to implement some different types of practices. And in this instance, it was an equine practice owner operating an S corporation. It was already an S, thank goodness, in the state of New York, but not in New York City. And the practice owner was filing jointly with their spouse. They had about $1,090,000 in income flowing to their personal return between wages and business income. So we don't necessarily need to break it down. I mean, I need to break it down, but in general, those are the numbers that are coming to their personal return. And these are some of the things we talked about that they wanted to do. They wanted to pay their children in their practice and save the most amount of money doing it. And we'll talk about how to go about doing that. They had a 401k plan in place, and they were contributing some through payroll deductions, but not to the maximum of their own contributions. And this plan had what's called a profit sharing component. And that is something where you have your contributions and your employer match during the year. And then after the end of the tax year, you can decide to share profits with your employees, but it's actually a percentage of each employee's wages, which includes the owner. And this is another reason to make sure that you're paying a reasonable salary, because you want to make sure you're maximizing the 401k benefit. And in this tax, for 2025, that maximum is $70,000. So between your contributions as an owner and the employer match and the profit sharing, you can go up to that maximum. They also had purchased about $100,000 in financed equipment during the year. So how do we want to do that? Do we want to depreciate? Do we want to take accelerated? What is the impact? In addition, they had built a new building costing about $500,000, and it had recently been placed in service, which becomes key because of an option that we have to be able to make a decision how to depreciate that building. And that is held in an LLC outside of the practice so that we protect that building liability, but also it helps shift income and expenses over to the other entity. And it's a good, savings altogether on the individual taxes. So this is what we decided to do. We instituted a family management company, which is a separate LLC, and we're back to Schedule C, but that's okay because the corporation is going to pay the Schedule C, and the Schedule C in turn is going to pay the kids. And if the children are under 18 years of age, there's no FICA tax involved. So they may only have the state withholding and any unemployment. So it becomes that where the maximum amount of money coming through payroll is going to the kids. And we also have another option there when you're paying your kids. You can say, you really need to be saving retirement now. Or, this is a good way to save tax free, put it into a Roth up to about $7,000 this year. And they can grow tax free over the up till 59 and a half. And then the contributions and the earnings can be distributed tax free. So that's a really good saving options for the child. But also, you may be saving for your child's education, and you might be putting some money into 401k plan, or excuse me, a 529 college savings plan. And that sometimes can actually earn a deduction on the state level. It is not a deductible contribution on the federal level, but it will help a little bit on the state. So maybe it makes sense still to do the college savings plan, but we could also maybe do the Roth as well. And if we need to tap into that principal, it's already been taxed money, so we don't need to worry about the tax implications of taking the principal out if we need to use it for college. And the other thing, we say to go up to about 15,000. And I think in this instance, it was just, sorry, one child that decided that they were able to make documentation and have them working. So it was only the 15,000. I think the second one was going to come in at a later date. And that $15,000, we use that because that was a standard deduction for a children's return or single return. And that way they don't have to file a tax return. You still have to do the W-2 and all the payroll filings, but you don't have to file a tax return if they don't have any other types of income. And that ends up saving about $8,500 in taxes. The next thing was the 401k contributions. Again, they can go up to 70,000. And I think down here at the bottom, you can see 70,000 generated about $45,000 tax savings. The equipment purchase was $100,000, and that was financed, so it's not all out of pocket. But we can capitalize it and take depreciation on it. And in July, they allowed bonus depreciation. And most of the states are following the bonus. Some may or may not follow Section 179, so we have to just make sure what's best on the state level. But in this instance, they were able to take the full 100,000, and it saved about $40,000 in taxes. And then the building held outside of the practice, we did what's called a cost segregation study. And I mentioned that because it was a new building. It was placed in service not too long ago, and it made sense. There's some other things that we have to do to put that into place for filing purposes. We won't get into that. But with this study, what it does is it breaks it down into its component parts. Some of them are deductible faster than others. The cost segregation study runs usually anywhere between $3,000 and $5,000, and you can depreciate certain items faster if you break it down into its component parts. The building has to be material enough to make that worthwhile, because that has to have the smaller component parts. And the other thing is, because I said earlier in its that it's newer in its depreciation life schedule, it makes sense because if it's a really old building and you fully depreciated most of the building already, you're not going to gain much of a value. So if you place that entire new building into service, it's subject to 39-year of taking depreciation systematically over time. And in this one, we were able to gain about $150,000 deduction because there were some smaller items that were eligible for the bonus and for Section 179 depreciation. So those are their two examples. I hope they were helpful because, I'm just trying to bring out points that, you can relate to. Is this something that I see in my practice, or is this something that I see in my life taking place? But I also want to talk about some targeted savings at the personal 1040 level. I can't help talking about numbers. I think it's an occupational hazard. But anyhow, on your personal return, what I will look for is I'll look at the spouse's W-2 and I'll see if they're maximizing their retirement. And if not, let's see what the maximum is available to them. Make sure they start putting that money away so that it doesn't even come on the tax return. It becomes a deduction. Some states also allow that, some do not. Pennsylvania is one that did not. I'll look at their investments. One, are they receiving a good return on the amount of investments they have, if I actually have the dollar value of the investments themselves? But the other thing to look at is, do we need to shift some income? Can they put it into state and local bond interests that may be um, based on the state that they are resident? So in other words, let's say Pennsylvania. I take out Pennsylvania state and local bonds. I get this interest. It becomes exempt on the federal level, and it also becomes exempt on the state level. U.S. Treasury bond becomes exempt on the state level only, not the, but is still taxable on the federal. So that's a way to actually shift income on both sides. Some people worry about the return because the bonds themselves do not give a high enough return. But when you take into consideration the tax savings, sometimes it becomes pretty close in being a good, safe investment as well as saving taxes. So the other thing we want to talk about that changed in July was, if you're able to itemize your deductions, which means you're deducting your state and local taxes, your real estate taxes, your mortgage interest, and your charities, that's what itemized deductions are. And you get that or standard deduction. Married filing jointly was 29,200 this past year. So if you didn't go over the 29,000, you just did not itemize the deductions. And that's still going to basically be the same. But what they did is the state and local taxes were limited to $10,000. And people with higher earner or states that have higher taxes were throwing that number well over $10,000, and they were not able to itemize. So they were really losing the value of that state and local tax deduction. And that was fought on many levels and came back into the bill this year. It bumped it up to 40,000, up to earners of $600,000 in income. Once you go over 600,000, then it's phased out. And there's an area in there where it phases out gradually. But then you're back down to 10. So we just want to make sure that you can take advantage of that higher deduction if possible. And also you might want to say, clumping another, I think I have it as another point, but you can actually take your itemized deductions and say, if you're close to that standard deduction, clump your charitable contributions in years, or your expenses in years where or pay your real estate taxes a little earlier, whatever it is, if you're not over those limits. And then you can bump up your itemized deductions and be able to take advantage of them maybe every odd year or something like that. The other thing too on here is something called a backdoor IRA, a Roth. And what that means is, for those earners that have a retirement plan through their employer, they're not maybe able to make a deductible IRA or a Roth IRA contribution. What they do is they make a non-deductible IRA, because you can make a non-deductible IRA at any income, and then you carry that basis forward. And when you ultimately distribute it, you make sure that you offset that basis. Instead of doing that, you can work with your investment counselor and say, I want to make a non-deductible IRA, and then I want to roll it into a Roth. So that's another way to get those Roths to be able to grow tax-free and help you down the line, and also diversify the type of money that you have available to you. So another area, oh, this is the bunching itemized deductions that I was talking about. That's the first bullet, and I already spoke about that. Another thing is taking advantage of real estate investments. And if you're in an area where real estate is appreciating, it is a good investment. Not everybody wants to be a landlord, but the rents usually cover the expenses, and then the depreciation will either bring that entity to break even, or it will bring it to a loss, and you can deduct those losses up to $25,000, and then from there it becomes suspended, but you don't lose it. It comes back at a later time. Also, if somewhere down the line you're selling your maybe you sold your practice and you want to sell your commercial building that you owned, or you have this real estate uh, building, home that you really don't want to have anything to do with anymore. There are things called a like kind exchange where you can say, as long as you don't take the cash back, what you do is you have an agent, usually an attorney that fills that position, where you identify another piece of property. It doesn't even necessarily need to be exactly the same type of property. It could be vacant land. It could be whatever. It's not going to be personal property, so you can't necessarily reinvest it in a personal home, but another type of investment real estate. And you can then say, we're going to exchange one for the other, and whatever gain I had in this property then gets down the road. And deferring taxes is always beneficial because the less we pay out now, the more value that money is to us at this point in time. So you could be in a position where you use like kind exchanges indefinitely and never have to pay that tax if the property rolls into your state. Your beneficiaries receive a step up in basis, and then nobody has to pay that gain on that. So it's one where you can kick it down the line almost indefinitely. Solar investment is still available on commercial property. It's not available for residential. So it might be that you want to put solar panels on your just building, or there are other type of investment vehicles where you are investing in solar and receiving deductions through credits or excuse me, actually depreciation. And then you also have credits. Credits are actually better than deductions because credits are dollar for dollar. For instance, if you have $30,000 of tax due, a credit will offset dollar for dollar. So say you had a $20,000 credit, you only have $10,000 due. If it's a deduction, you only get 28, 30% of that offset your income and your tax. So the other side of it is I want to talk about is kind of shifting back to the plans that we were talking about a little while ago. And the implementation of these plans is really important. Documentation is going to be really important. And at one point in time, I was reluctant to maybe advise these type of situations because taxpayers are not necessarily in the position to make sure that the documentation was done. But now I have some really good tools that help us make sure that is done. So this is an example of hiring your kids. You set up the family management. You make sure you're paying them a reasonable salary. You document the time they work and what they're doing. It's reasonable type of work for a child, and you make sure that all of that is documented. You're paying the payroll. You're doing the W-2s, the payroll filings, and so forth. But it can definitely lead to a good deduction. So these checklists are really great, and this is another one for income shifting from to the S corporation that I had in my example one. I want to make sure that we become an S corporation, that it's approved by the IRS, that we set up the reasonable salary, that we can allocate distributions, because once you pay money on uh, that tax on that money, you can actually start taking it out tax free down the line, as long as you don't, take it all out for basis purposes. And you may have to go back and adjust the prior filings like we did before, or you may have the ability to make the selection for prior years. I personally haven't done that, but it is option. So, what is the advantage of having a tax advisor? I mean, I personally have realized that tax preparation, the compliance work, I think that is by the wayside. I think businesses need to be advised, to help them make decisions on planning for taxes. It's a big expense. Let's make sure that we minimize it as best we can. Things are documented and so forth. We may have strategies that are available, but which ones are better? One for you may not be the same as one for someone else. In other words, that example I gave where it wasn't necessarily a strategy, but it was a cash flow choice to have withholdings instead of making estimated tax payments. Or we find we're going to have a big tax bill at the end of the year when we pay a bonus to pay that taxes. Timing is key. Sometimes sequencing how we do the strategies is very important. And sometimes doing too much at one time can be confusing. Sometimes you're in a situation where you have to clean things up, and then you take one step at a time, and you make those changes and put those implementation pieces in place. It may take a couple years, but basically, I think it's to any type of business not to just you know put the financial information to your CPA after year end and say, okay, please prepare the return, and set up estimated tax payments as the extent of your planning. I think it's to your advantage to have that planning throughout the year. So basically, that is my presentation. I wanted to say thank you. Just bring your attention back to the Vet Advisor. That's the book. It's available on Amazon. I'll send out the slides after our meeting. You can click on it. It'll take you right to Amazon. It's also available on Barnes & Noble. On my website, I have a free white paper download that has an abridged version of the book that basically talks about, how we do the business advisory and some tax planning tips as well. Here's my email address, and I do offer a 15-minute call if anybody wants to, see if it's something that they'd like to go forward with these type of services. That is the extent of my talk. What I'd like to do is now, and what I should have done before is just say that, if you have any questions, please drop them in the Q&A. I don't see any questions at this point, but I have encountered some where, so please take your time if you'd like to throw some questions into the Q&A or in the chat, either one, that's fine. But I've had some people say, well, what about the bookkeeping? I personally do not, do the bookkeeping per se. Will help people get caught up and in a better position. And then the key is that we have a good set of underlying records, and then we plan from there. Because otherwise, if we don't have good records, then we are not sure what options we have. And again, documentation is key. Oh, can you give more info on the employee educational debt deduction? Okay, so this is something where I should have put that checklist up, but where you actually create a plan within the business that you have an educational reimbursement plan that is available to all your employees. And as an owner, you can take advantage of it up to 5% of whatever your employees did, contribute or get reimbursed, I should say. So it's a type of accountable plan where they say, okay, here are my student loan deductions or my student loan payments. Here's the documentation. I'd like to be reimbursed for it. And you can reimburse them up to $5,250 per person. One of the keys that you're going to want to keep in mind is if you have a staff of 20 people, you want to make sure for cash purposes that you are able to do the same amount for everyone. So you might say, okay, you know what, I'm going to make the educational reimbursement $2,000 per employee, or bump it up at a later time so that you make sure you're never in a situation where you can't take care of that obligation and reimburse the educational expense. So again, it's through the business. It's a formalized plan, probably in your employee handbook. Does that help? I hope it does. Does anybody else have any questions? So let me see if there's anything. Oh, there's one in the Q&A. Is there ever a time a C Corp is better than an S Corp? Good question. Very good. Well, what happens is we with the S corporations, we have to have something that equalizes the tax impact, because the C corporations are now at 21%. And therefore, the qualified business income deduction is, as the S corporation income is coming to the individual, it kind of keeps us hopefully at that same level. That being said, and the other thing that's a detraction for a C corporation at lower levels is that it's subject to double taxation. So you know how in this S corporation, we can take that money out tax-free if we need it, if we've already paid tax on it, whereas the C corporation continues to accumulate those funds other than paying dividends. And dividends are not a deduction for the corporation, but they are income to you, and that's where the double tax comes in. But there are times, either if you want to take advantage of some more complex profit sharing plans or qualified retirement or some non-qualified retirement plans. C corporations can be better. And there's some other employee benefits that are a little bit better on the C corporation. I've also seen it where if you're selling, there is sometimes an advantage almost to moving to the C corporation if you can deal with something on the S that's called the built-in gains. I would say that it really is something that has to be analyzed. Most of the time, the S corporation is going to be to the advantage of most practitioners. I'd say if you're under $10 million, I'd say even under $20 million, and you expect to continue going on, that's probably a better entity, but definitely talk to your tax advisor because they can definitely weigh exactly where you stand at this, at any given point and to see whether it's to your advantage. Okay. Only for debt and loans or current school expenses. Oh, okay. I guess this is another question on the student loan interest. It can be on your current payments. So it's principal and interest on the current payments. And it can be for education reimbursement. If the employees go out and pay for their own education, they're going to get a higher level. Maybe you have a staff that wants to become a technician and they go and they pay for their technician school, you can reimburse them extent for that. A lot of practices already pay for professional education, but this is something that the employee pays out of pocket and is reimbursed, and it's accountable to the employer. And it can be for student loans, the current payments. It's not necessarily deducting the entire amount of debt, it's what is being paid in that year. And I hope that helps clarify that question. Good. Okay. Let's see here. I don't have any other questions in the Q&A, and I'm not seeing anything else in the chat. So I think we're just about where we should be. I know this was for one without a guest this year, but I hope that this gives you an opportunity to be able to think about things that are coming maybe close to the end of the year. There's a few things you can do before the year ends, or what can you take into 2026 and take advantage of. Those things are all advantage. And the other thing too is if you're looking for checklists or anything like that, send me an email because I do have a really good checklist that goes through some of these items to keep in mind. And I'd be happy to send that out to you. Actually, what I can do is I can send it out to all of the people that signed up registered for the webinar, along with the slides and the recording. So I hope some questions have been answered, and I hope you all have a wonderful evening and a very Merry Christmas and Happy New Year. Thank you very much for attending, and I hope you have a great day.